And this comes up time and again in tax considerations, particularly in stamp duty and stamp duty land tax. It takes me ages sometimes talking to some of the girls and boys in my office that if you sell shares and receive in consideration a new issue of shares in another company, happens all the time, sort of share exchange. I own shares in company A, company B wants to acquire company A, so I sell my shares in company A to company B, but what do I get in exchange? I don't get money, I get new shares in company B, happens all the time. What do I value for the purposes of stamp duty? I don't value the shares in company A. It's the consideration that you pay stamp duty on, and the consideration is the shares in company B. It's a very important point, because if the shares in company B are a minority holding, I might be able to discount those heavily. So I mean, it's just a very, very interesting point about if you've got a transaction that involves sort of two assets, which are you valuing? Here we are told that you only value the house in certain circumstances. Okay, very important, very important. Now, let me flesh it out a bit more. A typical situation is this. Supposing you have the situation where you have a shareholder in a company, controlling shareholder in a company, let us say, it doesn't matter whether he's controlling or not, but let's assume he is controlling, just for the sake of this example, who wants to retire. And he wants his son to take over. So you have father who owns, I don't know, let's say 60%, just for argument's sake. Son owns 40%. Father wants out. He's had enough. He's made his money. He wants to go and put his feet up somewhere. And he wants to sell his shares, but his son can't afford them. And in any event, if his son were to afford them, his son would have to get the money from somewhere, which would probably be out of the company. So if his son is having to strip money out of the company, probably he's going to trigger personal tax on doing that. And we've just been looking, haven't we? Personal tax is damn sight higher than corporate tax. So we don't want to do that. We do not want to trigger personal tax and national insurance contributions. So we realised we could get the same result by selling the shares back to the company. We say to the company, which is difficult conceptually, of course, talking to your company when you are the director, but the directors get together and agree that the company will buy in those shares. At which point, of course, the son will go up to being 100% holder of the shares, holder of the company, and the father will be out of it. Now, can the revenue interfere with the value that the father goes for? Very interesting point, this. Very, very interesting point. And the answer is, the revenue, well, there's two answers really. There's a practical answer and the technical answer. The practical answer, the revenue seem to presume that in these circumstances, there is an arm's length negotiation going on. That the son is not going to want to pay too much for the shares. The father might be prepared to go for less than would otherwise be the case, but he wants an easy way out. So there is a presumption that the transaction will be at arm's length. That is an important practical point. But the technical point is this: the market value rule only triggers if there is an acquisition. When you look at how the market value rule works, particularly as regards transactions between connected parties, it is predicated about an asset being acquired by the acquirer as well as being disposed of by the disposer. Now, what am I getting at? The point I'm getting at is a simple one. When a company buys in its own shares, it doesn't acquire anything. A company does not own its own shares. I mean, it is now possible under some arcane aspects of the 2006 Companies Act to hold shares as treasury shares, but under general principles, if a company buys in its shares, they are immediately cancelled. In our example, let's say there were 60 shares owned by father, 40 shares owned by son, the 60 get acquired by the company, cancelled, the son goes forward with his 40, which is the whole of the issued share capital. The company has not acquired anything. And because the company hasn't acquired anything, the market value rule does not trigger. And I have seen the revenue start implying that they didn't think the market value was the right value and they wanted to check this and they wanted to check that. And I've seen other firms sort of going along with this. And please believe me, I have on various occasions told the revenue in no uncertain terms there is no debate to be had. There is no acquisition. The market value rule does not apply. So very, very important point that. Very important point. Now, but equally the important point is that if there is an acquisition and you have, let's say, father giving shares to son, there is a disposal and prima facie it's a disposal at market value. So that prima facie gives rise to capital gains tax charges. So if you are going to go round thinking, let's make a gift here, let's make a gift there, it'll all be all right, because I'm sure you don't have to pay tax on gifts, you might need to think again. Which leads us nicely on, does it not, to gift relief. The only reason you would not pay tax on a gift of shares would be if there was a specific relief. Happily, there are two specific reliefs. But will they be of any use? This is the $64,000 question. So gift relief number one relates to gifts of business assets. So if you have the situation where you have the right kind of asset and you make a gift of it, you may well be in the happy position that you will not have to pay capital gains tax. You may well be in the happy position. But this is an area riddled with pitfalls, riddled with traps for the unwary. So let's take them one at a time.